Good morning from New York. As Wall Street opens today, the dominant emotion is not fear, it's caution. Markets are functioning, liquidity is present, trading is orderly, but beneath the surface, something has shifted. Confidence has softened. Investors are no longer leaning aggressively into risk. They are stepping back, reassessing assumptions and recalibrating exposure. This is what it looks like when markets begin to reprice risk. Not dramatically, not emotionally, but deliberately. Today we're going to unpack why Wall Street is on edge, what exactly is being repriced across assets, and why this moment matters more than the headlines suggest. When markets are described as being on edge, that does not mean panic. Panic is loud, panic is fast, panic is indiscriminate. What we're seeing instead is unease. Narrow leadership in equities, reduced appetite for speculative trades, higher sensitivity to economic data, a renewed respect for downside risk. Markets are asking harder questions. They are questioning growth assumptions. They are questioning rate expectations. They are questioning political stability and policy continuity. And when markets question narratives they once embraced, repricing begins. To understand today's market tone, we need to rewind. For much of the past year, markets operated under a powerful consensus. Inflation would fall steadily. Central banks would pivot toward easing. Economic growth would slow, but avoid recession. That consensus created a fertile environment for risk-taking. Stocks rallied, credit spreads tightened, volatility collapsed. But consensus is fragile. It survives only as long as data cooperates. Recently, that cooperation has weakened. Inflation has cooled but unevenly. Growth has moderated but remains resilient. Labor markets have softened but not broken. That combination complicates the outlook, and complexity forces markets to reassess probabilities. Let's start with stocks. This is not a market in retreat. It is a market in rotation. Pressure on cyclical and rate-sensitive sectors, relative strength in defensives, a pause in mega-cap leadership. This tells us something critical. Investors are not abandoning equities. They are becoming selective. They are favoring balance sheet strength. Overgrowth narratives, cash flow over promises. Pricing power over momentum. That shift matters because selective markets are more volatile markets. One of the most important developments underway is the return of valuation discipline. For a period, valuations expanded on confidence alone. Low volatility, high liquidity, faith in central bank support. That environment is fading. Now investors are asking, are earnings forecasts realistic? Do multiples reflect rate realities? Can margins hold if growth slows? These questions don't crash markets, but they cap upside. And when upside becomes limited, risk premiums rise. If equities express emotion, bonds express conviction, and the bond market has been clear, yields remain elevated. The curve remains under scrutiny. Term premiums have increased. What does that tell us? It tells us that bond investors are not convinced inflation risks have vanished. They are demanding compensation for uncertainty. And when bond markets reprice risk, every asset class listens. The phrase higher for longer has lost some of its shock value but not its relevance. Rapid disinflation, aggressive rate cuts, a quick return to accommodative policy. That assumption is being challenged. Central banks, especially the Federal Reserve, have been consistent. Policy will remain restrictive until inflation is decisively controlled. Premature easing risks credibility. Financial conditions are a tool, not the goal. Markets are adjusting to that reality, and adjustments bring friction. The Federal Reserve sits at the center of today's repricing, not because it has changed its message, but because markets are finally hearing it clearly. The Fed is not trying to engineer a rally, it is trying to restore stability, and stability does not mean asset prices only move higher. It means inflation expectations stay anchored. It means labor markets cool gradually. It means credibility is preserved. Markets ran ahead of that message. Now they're correcting course. Inflation today is neither runaway nor resolved. Goods inflation has eased. Supply chains have normalized. But services inflation remains firm. Wages matter. Shelter matters. Healthcare costs matter. This makes the inflation path slower and more uncertain. Markets are coming to terms with that, and uncertainty increases risk premiums. This repricing is not limited to the United States. The European Central Bank faces similar challenges. Weak growth, persistent inflation pressures, political fragmentation. Global central banks are navigating a narrow path, and markets are no longer assuming synchronized easing. Divergence adds volatility. Markets prefer predictability. Politics threatens it. Election cycles, fiscal debates, trade tensions, and geopolitical risks are becoming harder to ignore. Bond issuance, defense spending, energy markets, corporate investment markets are beginning to price political risk more explicitly, quietly but persistently. Credit markets are an important signal. So far, they remain orderly, but spreads have stopped tightening. Issuance is more selective. Lenders are cautious. Financial conditions are tightening at the margin. Risk tolerance is declining. Leverage is being reconsidered. These are early signals, not alarms. For a long time, volatility was absent. That absence encouraged complacency. Now volatility is returning, not as chaos, but as information. Markets are rediscovering price discovery. That's uncomfortable but healthy. For investors, this environment demands discipline. Diversification, liquidity, risk management over confidence, leverage, cash has yield again. Quality matters again. Patience is valuable again. Let's be clear. This is not a crisis. This is not 2008. This is not systemic stress. This is normalization. Markets are relearning how to function without constant policy support. That transition is never smooth. Every market cycle includes moments of reassessment, moments when assumptions are tested, when narratives fade, when risk is repriced. These moments are necessary. They reset expectations, they restore balance, they prepare markets for sustainable growth. Wall Street is not panicking. Wall Street is recalibrating. Risk is being repriced. Because certainty is being questioned. And in markets, questioning assumptions is how stability is rebuilt. I'm Jonathan Ferro in New York. We'll continue to monitor how markets respond as the session unfolds.